The Small Caps is partnered with the Australian Stock Report. Looking to make better investment decisions? Visit australianstockreport.com.au.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Good afternoon, it's a Friday and this is The Call. 10 stocks picked by you, 2 expert guests over the course of 60 minutes. The 19th of August, and I'm Nadine Blaney sitting in for David Kosh. Now, joining me this hour, Andrew Page from strawman.com.au and Luke Winchester from Merewether Capital. Guys, welcome. Andrew, I'll start with you. Got a lot to get through today. 1 to 10, how would you rate this reporting season so far, of course, but for the small end of the market?
It depends on what part of the small end of the market you want to look at, but I think mostly for the ones that we follow, actually pretty decent. There's definitely been a real disconnect between share price performance and what the actual businesses have done, but perhaps therein lies the opportunity. There
you go. Luke, same question to you. Out of your company of portfolios, has it been mostly positive this reporting season?
Yeah, it's only a trickle so far, Nadine, for the smaller guys. They, tend to be a bit slower than the large ones. So, ask me that next week. My opinion may very well be different, but so far so good. You've put a number on it, maybe 7 or 8 out of 10. I'm feeling pretty optimistic, and I've said a few times leading up to the reporting season that the outlook statements will be very important. And so far, cautiously optimistic is probably the best way to describe it. Most businesses are saying, you can see the potential issues that are out there, but they're not hitting them right now. And you prepare for the worst and hope for the best. And I think that's a good strategy for a lot of businesses at the minute. So, no, look, and to be honest, it's just good to be talking about company fundamentals again. I mean, I can't remember the last time I've had to worry too much about inflation or interest rates or whatnot is going on in the world. So it's good just to focus on numbers and operations for once.
Yeah, he digs his deep into those company reports. All right, Catapult is on the list today. CAT, that's for Sol. We've got intelliHR. We've got Bapcor reported this week. Redbubble as well. And Credit Corp CCP on the list. But we're going to the stock of the day, and that's AGL. It has seen its profits more than halve in FY22 to $225 million, blaming lower wholesale electricity prices or volatility in electricity prices and an outage at its Victoria station. 10-cent per share dividend, but investors won't be able to access a reinvestment plan. It's been a very turbulent year with its proposed demerger being scrapped and Mike Cannon-Brookes lobbying a takeover bid for the company. AGL says its next year's earnings will remain resilient. Then from FY24, it expects to benefit from elevated wholesale prices. Shares, though, sliding today. So what do our experts think? And I will preface this by saying we will be speaking to the company's CFO a little bit later on in the program. So Luke, I'll start with you. What would you want to know from AGL? Is there anything that would make you invest in this company now?
It's a large cap, Nadine, a real mega cap, so it's not one that's across my radar every day. And it's interesting, we get the stock of the day about an hour before the program, and most of the time, I can look at most companies and get a pretty good feel for what's happening and sort of dig into one or two key issues and have an opinion on them. This result, I must admit, I looked at it for half hour, 45 minutes, and it's probably one of the messiest results I've seen in a long time. There was so many moving parts to this business, and I honestly struggled to really get a feel for what direction the business is going in. The share price certainly suggests there's some struggles ahead of it. And if you take a step back from the operating environment, you're talking about a business still dominated by coal production and record high coal prices, the volatility of the energy market you were just discussing, and then the ongoing issue they face of this is a business that sort of sees its future transitioning to renewables. But how do you balance getting to that future versus maybe maximizing the cash flows out of the assets you have now. So it's very difficult, and they're probably some of the questions that investors need to ask themselves. It's ironic I'm on here with Andrew, because I know one of the things he loves to say, Nadine, is you don't get extra points for complexity in investing. And it's the first thing I thought about when I looked at AGL. It was just so complex. I think even if there are opportunities here, and someone like Mike Cannon-Brookes, maybe he has more of an altruistic approach to a business like this, but obviously he sees value in it, and I'm sure plenty of other investors do. The complexity to get to that value is just too difficult for me. So it's a large cap, so I couldn't look at it anyway. But even if I could, I'd just sit on the sidelines until you got much more certainty around just a few of those moving parts and a bit more stabilisation in the operating environment as well.
Strategic review, board renewal, activist investors on the register. Is it just too hard basket?
I don't think I've ever heard the term strategic review being uttered when things are going well, right? So that's probably the first thing to pay attention to. But look, even before these latest set of results, it's been a dog's breakfast. I mean, shares are down half from where they were 10 years ago. We just saw the 5-year chart there. And I'm not a chartist, but you want to plot out what the fundamentals have been doing, whether it's a sales or an earnings or a dividends. It's just really, really ordinary. And structural change is something that I very much pay attention to, because there can be huge opportunities when industries undergo such significant change, but it's usually not a good thing for the incumbents. And the business here, I think the board needs to be taken to task. Mike Cannon-Brookes makes a lot of sense when you hear him talk about it. What's happening with this industry and energy generation has been on the radar for a long, long time, and they sat on their hands. Things have been politicized, and lo and behold, they're bearing the consequence of underinvestment, poor capital allocation. Can it be turned around? Potentially. But, as Luke was saying, you don't get extra points for degree of difficulty, and this is just way too hard. No thanks. Much better opportunities.
So you'd sell it?
Yeah,
if
in
you
a
had
heartbeat.
it.
In a heartbeat.
Got it. Thanks, guys. And as I mentioned, we'll be speaking with AGL a little bit later on. Damien Nix will be joining us, the CFO of the company. There you go. Let's get to the companies that have been nominated by you for us to discuss. Let's get to the first stock, and that's Catapult. CAT is the ticker code. This is for Sol, and he's given us a bit of context as well. Andrew, I'll start with you. He says, what are your thoughts on Catapult for a long-term hold? It's in the sports and fitness monitoring business, and that's just a very broad stroke.
I'm smirking a little bit.
And it would probably call itself a data business, I would say.
It might do that too as well, yeah. I've got a love-hate relationship with Catapult. I've actually got a fair number of them. I have for a long time, soon after they listed. It's one of these businesses that, without getting too far into the weeds, they do sports analytics. The top line growth has been phenomenal. I just mentioned structural change before. This is exactly what's happening with the elite sporting market. Things have gotten to a very exact science there. So you want to know what your players are doing. Imagine a Fitbit that you might have on when you go for a jog, except something that measures 1,000 different data points and integrates with video and tactical software and even spits out data for media consumption. It's huge, and they're by far the largest in their space globally. At least 5 times larger than the nearest competitor.
So why can't they make a profit?
They can't make a profit because I feel as though under previous management they had some malinvestment. They weren't good at managing their capital. They brought in a gentleman called Will Lopez a couple of years ago, former CEO of Audible, who's come with a very, I think, focused, deliberate strategy. He's turned things around. So what you actually see is a little bit of a stall in the top line growth in the last couple of years. 2 parts to that. One was COVID, which we know shut down a lot of sport. 2 was they've moved to a subscription model. And what's interesting about Catapult today is they're pretty much there. 92% of the revenue is now subscription. They have seen some huge traction in their annualized contract value. It's up 32% last year. They're calling for 20 to 25% growth. They're saying that they should be operating cash flow positive in the current year. They were for good parts of last year as well, in fact. So I think some of that ill discipline from former years is now gone under Will. They're looking at a 400 million ACV target in the medium term. That's 4x what they're doing now. So yeah, there's some risks there, but it's an exciting market. And you're getting this for like 2.5 times ACV, which, for a lot of sort of growth companies, long runway, good economics, low churn, all of this kind of stuff, it seems compelling. So it's one of these ones where the pendulum will swing to like ridiculously undervalued to overvalued. And not that I'm a trader, but I would certainly say at this point it's at the lower end of that. And I think last time I ran the ruler over it, I thought it was worth about $1.40 on pretty conservative assumptions.
Okay, so that is the annual contract value when we're talking ACV, so that's a buy.
Yes.
That's a buy for you.
That's a buy for me.
What about you, Luke? Would you be buying Catapult? And keeping in mind, Sol wants to know if it's a long-term hold.
I wouldn't buy it today. I would hold it if you're there. Look, it's a business to watch. I've got it on my watch list. And the reason why, that core business is so good. Andrew points out it dominates that professional sports niche with 70-80% market share and growing because previously it was the top of the top of professional sports, but it's now becoming much broader to lesser leagues around the world. The ramp up in costs probably alarmed me in the last report, and Andrew's right. The management team, they were very upfront about it and called out the need to do it. But nonetheless, to just see the numbers, it was sort of eye-opening when you go from a $5 million free cash flow profit to a $18 million loss in 1 year. And the revenue growth obviously lags that investment, is also part of the problem. You weren't seeing the sharp growth to go along with it. I get the strategic appeal of the, they call it tactics and coaching, which is like the video analytics stuff they're doing. I think there's some good cross-sell there with their core performance and health. The segment I've never liked for years is the prosumer. So they've tried to shift away from professional sports to that, upper tier of just consumer athletes or people who want to be more active about their own health and sort of get more of that feedback that Andrew was talking about. It's a much, much tougher market, though, much more competitive, much lesser moat, much higher churn. I just don't think it has anywhere near the economics. The addressable market's big, which is why management will talk about that. I just don't think the economics would stack up anywhere near the core business. So for me, I've kept it on my watch list for many years. It's one I would love to own. It would probably be a combination of the metrics improving, but also I'd love to see, Andrew was talking about a strategic review. I'd actually love to see a strategic review where someone came into this board and said, look, let's stop throwing money at prosumer. Let's focus on our core. We've got a great niche there. It's still growing so strongly as well. And I think they could get some pretty fat margins out of that if they really wanted to. So hold for me if you're there, because you know all that.
Yep.
And it's so dominant, but I couldn't buy it today.
Got it. Thank you. Differing of opinion, but I like that. All right, let's get to the next company on the list. And I'll start with you for this one, Luke, because I think we've talked about this before. It's intelliHR. So it's a software company. It essentially is enabling HR departments and workplace empowerment and all of those sort of very HR-y kind of terms. What do you think of it as a business?
Yeah, well, look, you're killing us here, Nadine, because you've hit Andrew with probably one of his worst performers with number one, and now you're going to hit me with number two. I own this in Merewether Capital. It has been the worst performer. Stock price down sort of 70, maybe 80%. There's the chart there. I wrote it up in my July report. So Alex, who wrote it in, you can jump onto Merewether Capital and read that report where I have about a page or so on my thoughts of intelliHR on the latest quarterly. So I'll keep this brief. It's a 2021 stock stuck in 2022. So HR SaaS, all the operating metrics are fantastic around net revenue retention, low churn, high growth, but the cash burn that comes with it is obviously really spooking the market. The last quarterly I thought was promising. The headline numbers, they still lost, $2.2 million cash, and with only $5.5 million in the bank. There was no real reaction from the market because you can still see the spectre of a capital raise. But the focus on the capital from management is starting to come through. They reduced their operating costs by $300,000. Growth still continued. Passed on price increases to their customers. So watch churn in the next couple of quarters. That's always a big one whenever you see a price increase. Just keep an eye on that churn number. But where I'm getting a little bit more optimism is they're now trying to leverage partner networks. So leveraging other resellers and partnerships where it becomes a bit more capital light for intelliHR because your partners and your resellers will take on some of the onboarding, implementation and support. So that obviously can reduce your operating costs. So look, I've held it, Nadine. I haven't, I bought it a while ago, obviously. I haven't added to it. So for me, it's a hold. I think it's one people put on your watch list. I mean, this has been well and truly beaten down. And like Andrew said, there's opportunities in this small cap tech at the minute. I mean, I think this is one that if they can sneak away a capital injection lower than what the market expects and tilt into that break even quicker, it can do really, really well because the underlying business is very strong.
Andrew, would you be tempted to get into intelliHR? Do you think it's cheap enough and on a path to profitability? When?
Yeah, well, isn't this interesting? I think intelliHR is a great case in point of what we have seen in small cap growth over the last year or so. Go back to 2021, 2020, it was all about top line growth.
Yep.
And the top line growth here has been insane, right? You don't have to go back far, and they went from pretty much a standing start to, what was it, $2.5 million last year, which was double the prior year. The recent 4C, the annual recurring revenue, it looks like it's going to double FY21. Really great results, you know, everything is there. And yet you see this share price chart, which makes you wonder what's going on. And I think it's that shift in sentiment from we only care about the top line to now we care about cash flows.
Okay, so it's the shift, it's the baby potentially with the bathwater.
I think so. And
is it cheap enough for you to buy now?
I'd need to do more due diligence on it, and this is always the frustration with me because the answer is always it depends. But yeah, Luke touched on it before. The thing to watch here is the cash burn and the current cash left. So they need to do a capital raise pretty soon. Doing a capital raise when your share price is soaring is a great cost of capital kind of exercise. It's 7 cents a share. If they wanted to raise $10 million, just to pick out a number, they'd have to increase the shares on issue by 50%.
Which is not great for existing shareholders.
It's not great for existing shareholders, but that's probably one of the things I would watch. Once the balance sheet was in better shape, I'd be very interested.
Okay, so this is a watch and wait for you. Okay, you don't frustrate me, Andrew. I like you. But yeah, buy, hold, sell. Let's stick with that.
I know.
Okay, Bapcor then. Bapcor released its results this week. Did you pay any attention to Bapcor's results? There's been a change in management there. This long-term CEO was out. There's new ones coming in. It's obviously leveraged to, you know, the car market, which has been really strong, but it's also leveraged to the consumer.
It is. So this is a company I used to hold. I don't hold it anymore. When Daryl stepped down, I was no longer interested. He was such a core part of the thesis for me, such a great operator. And that's not to cast any shade on their current management team. They're yet to sort of prove themselves out. But look, the recent results were okay. It was really a year that was a tale of two halves. A first half really impacted by lockdowns, and a second half that really seemed to come back. So even though net profit was essentially flat for the full year, it was up 16% second half to first half, which was a really great result. 20% of their business is retail, but half of their retail business is non-discretionary. So you need to get a battery for your car. So it's actually a business that's very counter-cyclical, because generally speaking, in economic tough times, people will put off the purchase of the new car. They'll make the existing one go for longer. They'll need more parts. And if your car breaks down, you don't put that off. It's an essential thing for so many people. So I think there's a lot to like about the business. You know, 7% net margin, nice steady earnings growth, good runway for growth just on store openings, et cetera, et cetera. And now you're getting it for a yield of about, let's call it 4.5%. You throw in some franking credits. Let's call it a PE of about 17. It's not cheap. It's not expensive. If I owned it, I would probably continue to hold it. But for me at this point, it's not a question of not liking it. I just like other things more. So it's not a buy for me personally.
Opportunity cost.
Yep.
There you go. Luke Winchester, Bapcor. This one's for Nancy. What is it? A buy, hold, or sell for you?
I agree with most of that. I think it's a hold, Nadine. 17 times earnings, same numbers I get to. The stronger second half, so you can sort of see annualize that second half out. FY23, maybe that reduces a bit. The biggest issue I saw, though, is the Bapcor balance sheet is starting to get a little bit stretched. They had some weaker cash conversion this year because of a build-up of inventory. And they're going through a pretty heavy CapEx cycle as they build out some distribution centres in Victoria and up in Queensland as well. So, you know, from a cash point of view, the business lost about $40 million, but then decided to pay a $70 million dividend. So, you know, again, funding essentially out of debt, which means that the debt goes from 200 million to about 350. And as Andrew said, this is a steady business. It's pretty counter-cyclical. It can handle debt. So, you know, from that point of view, it doesn't alarm me too much. But you throw the disruption of the management team on top. You know, again, the word strategic review got thrown around. You know, it's always a little bit of an orange flag. I struggle to come in and buy it. So I'd hold it if you're there. The valuation's, you know, not crazy. But just be mindful of that debt level and be mindful of that cash conversion as well. You know, build up of inventory is something you're seeing across a lot of retailers. You really want to see that unwind and turn into cash, maybe in this next half.
Got it. Thank you. Now, we've got to leave ourselves some time for this next one because I happen to know there's a few people out there that have been hanging out to hear you guys discuss Redbubble, RBL. This is for Steve. It reported this week an FY22 loss, a big loss, $24.6 million. The pandemic pump, well and truly over, you've got to say, for Redbubble. The share price, if I recall, on the day was down maybe around 35-40%. Yeah, it was a pretty terrible story that maybe we didn't talk about enough that day because there was so much else going on. But look, this has got to be the poster child for a lot of that exuberance in the pandemic, the e-commerce move, the masks, etc. So where to now?
Yeah, I think you throw Redbubble and Kogan up together there, Nadine.
Yeah.
Temple & Webster, I thought it was actually a decent result. Maybe it's shrugging off the pain that some of its peers are seeing, but it was a pretty ugly report. The headline numbers, I won't go through them. You just went through it, but even the outlook, it goes to show this is a business that is going through some changes. And I think it's right that the market is really questioning management's ability to guide through the issues that they're seeing, and whether they can get anywhere near the aspirational targets they've got for what is now FY26, FY27. I think they pushed that out from FY25 previously. So what I'm referring to there is this business used to be a Google machine, basically. You would position yourself to be one of the top hits on Google for whenever someone wanted something printed on a mug or a shirt. You pay your Google tax, but you hope to obviously leverage the arbitrage between the tax you pay to Google versus what you can collect from your customers. And the problem is that Google tax has dramatically gone up. And so the business is now trying to pivot to being more of a brand. And so trying to attract people before they hit Google and have the potential to be churned away to other people. But even if you look at the metrics they provide, they still struggle to get repeating customers to this business. Most of the business comes from new users who use it once and then that's it. I think people question the quality of what they get from Redbubble is also an issue there as well. So, they're calling out increase in brand marketing, increase in OPEX, a 20 to 30% rise in operating costs next year has already been flagged. And the market, I think, just simply doesn't believe revenue can match that. And so you're going to look at operating losses widen even further into FY23. How do you get the confidence that they can swing that back to profitability by FY26, FY27? So look, I think it's a sell. I think you sell this business and you sit on the sidelines. There is a lot of water that has to go under the bridge, and I think rightfully so. The market's got big question marks around the targets they've got out for the longer term. Right.
Okay. Luke is a sell. It's interesting because you can look to Etsy. Etsy came out with an above consensus report in the US, which is a sort of similar business model there. And I remember on the day Redbubble's share price went up. Yeah. But I thought it was interesting, Luke saying that it's trying to build itself into a brand, because Etsy actually is a brand in the US. People go to Etsy for something particular that they're looking for because they know what they're going to find. I just don't think Redbubble is that here.
That was always the hope. If you can do that, you avoid the Google tax, as Luke said. You get the repeat purchases, but it's not there.
Redbubble.
It's not there yet. I've tried it myself as a consumer. The quality wasn't great. And look, I probably won't go back there. That's a sample size of one, but clearly that seems to be something else. Well, two, and others I've heard as well. So it's a great concept. It's just the question you've always got to ask here is where's the moat? A few years ago, you could have made the case, and many people did, that there's a bit of a network effect at play. Lots of customers come on, which attract more artists, which mean there's more content to put on your mugs and your masks and your shirts, which attract more customers, and you have this wonderful virtuous cycle. They also have this wonderful characteristic of negative working capital. You put an order on Redbubble, they take your cash, then they get that fulfilled. So they're not having to have all this inventory sitting around waiting to be sold. So all of these attractive things, but it just hasn't gained the traction. So this is a really good textbook case of the danger of extrapolation, which is what we all do when it comes to investing. We see a couple of good quarters, a couple of good halves, and we just say that's what it shall always be like that. Look at Zip or some of the other hot sort of stocks that get in there. But it's worth remembering that the trouble with that is even if you're right and you're paying these elevated prices, it's in the price. So you have this, unfortunately, this very asymmetric bet where things just can go gangbusters per expectations. Okay, I get an average return, or it doesn't, in which case there's a lot of downside. So it's a sell for me as well.
Okay, so I will play contrarian for a moment. It doesn't look very cheap. I mean, even if they execute, part of the vision, looks like a bargain right now, doesn't it?
Yeah, it really does. Actually, I'm glad you said that because I had a look at it. The price to sales, which is a very horrible metric, but there's a nice rough and ready kind of benchmark there. It's a price to sales of a half. And I was just saying Catapult looked interesting at 2.5, right? That is true, but then the potential here is one of a value trap, where the multiples sort of look decent, but if that revenue line falls or the earnings never come through, the cash keeps burning, it's just never going to deliver.
Wait for that turnaround then.
I think there's something to be said for the a risk-adjusted return. So by sitting on the sideline, let's say that things turn around and go really well from here. Obviously, buying at this nice depressed price is going to do you very well. You wait for that to come through. You'll, by definition, almost be buying at a higher price. But I would say be buying at a better risk-adjusted return, because there'll still be a lot of upsides if the turnaround is there, but you're buying with far more certainty.
Yeah, got it. All right, so that's the conversation around Redbubble for now. Look, last on the list before we get to the halfway mark, around about there, is Credit Corp, CCP. And this one is for Rachel. I don't have any context, so it is one of those questions. Is Credit Corp now a buy, hold, sell today?
I think it's a hold. It's a very exceptionally well-run business, but a very hard business.
Yeah.
So they buy debt off other people. So you fail to get your invoices paid, you can sell off these debts to other people, and they're in the business of collecting it. So they'll buy $1 worth of debt for 60 cents and hope to collect 70 cents. That's basically the model. There was another company called Collection House not too long ago.
It's gone bust, hasn't it?
Yeah, that was the one I chose to back in the day.
Good.
Yeah. So I picked the wrong pony there. I mean, the economics are so wonderful when it works, but when, as Collection House showed, when it doesn't, things can unwind very, very quickly. It's a very capital intensive business. You need a lot of money to buy all of this stuff. All the money goes out, you buy these debt ledgers, then you've got to chase it. So it's a question of how much debt is available, it's all about what price do you pay, really, and in the context of how you can collect that. So these guys have excellent runs on the board, very high return on assets for what they've managed to do. They have talked a bit about some staffing issues in a very tight labour market. But what do you get now? PE 15, yield of 3.4%. You could probably expect mid-single digit type growth going forward. It's a very respectable, decent business. Not sexy. You're not going to be, buying a Lamborghini next month if that's your thing.
Lambo.
Lambo. Right. But for me, it's a hold.
If you've got it, hold it. Luke, what do you think? If you were Rachel, would you be buying? If she's got it, would you hold, or would you be getting out other opportunities elsewhere?
I can actually come to a buy on Credit Corp, but on the proviso, it's someone with a long-term focus. I don't think this is one you buy for FY23, because I've already sort of flagged FY23 could be a bit of a transition year for the business, and it goes to something Andrew was just highlighting, which is these guys need a operating environment that's not too good and not too bad, that sort of Goldilocks environment where there's bad debts coming out of these institutions, but consumers aren't in such horrible spaces that they're able to, collect some of them, not all of them, and make a good return. So you need that balance of debts, but also a decent consumer. And right now, they haven't got the debts, and they have some, slides in their deck, and we've got CPA coming up later. Spoiler, sorry, Nadine, that are saying the same. Aussie consumers are perfectly fine at the minute with delinquency rates at some all-time lows. That may change, and I think people, with interest rates rising, some people are getting ahead of that data and predicting some carnage, but it's not coming through right now. But to go back to the first thing Andrew said, these are world-class operators in a very tough market. So what do they do in the face of a tough operating environment here in Australia? They're letting their book go into runoff mode. So they're actually collecting more of their current book than they're replenishing it. Their Aussie book fell 8%, so negative growth in that sense. But it's quickly becoming a US story, to the point where this year they plan on buying $150 million of debt in the US compared to just 30 mil in Australia. So that's the long-term growth and why I could say it's a buy, but be aware you're going to have some jitters because that core Australian earnings engine doesn't look as strong as what it did over the past few years.
Got it. All right, so it's a buy and a hold for Credit Corp. That brings us nicely to the halfway mark. And in terms of stock of the day, AGL, just too difficult for both of my guests. It's an avoid for both of them. I think Andrew called it a dog's breakfast. That's the quote. Catapult, it's a hold for Luke, but he says it's one to watch, actually. He'd love to see a strategic review, wants it to focus on the core business. It's a buy, though, for Andrew. He owns it. He is looking forward to days when ill discipline of the past is long in the rearview mirror. intelliHR, look, Luke suffered on this one, but he's still holding it. If you don't own it, he says put it on your watch list. There is a capital raise coming. Andrew says, yeah, put it on the watch list, but watch the cash burn and how much current cash is left. Bapcor, it's a hold for both of my guests. Counter-cyclical, okay results. Nothing to set the world on fire, I don't think. Redbubble, both of them would be selling. Where is the moat for Redbubble? Andrew asks. All right, Credit Corp, you just heard it's a buy for Luke. It's a hold for Andrew Page from strawman.com.au. So we have a high conviction fund that we're following here at ausbiz. It is picked by our investment committee. You can watch that. Just search investment committee online at ausbiz.com.au. Here is the update on the portfolio. Heading into August, Audinate was removed. Interesting. Audinate reports next week. Oz Minerals was added. Stroke of genius, considering that offer that came through from BHP and the share price reaction to that. And we also upped our Woodside holding size. So performance is, well, we'll keep you updated on that as the week progresses next week. Keep sending the requests. We don't have any double buys coming through today, so we'll keep at it after this very short break.
The Last Call is brought to you by AVL Wines. Invest in the home of Australia's premium wine, spirit, and ready-to-drink cocktail brands.
Welcome back to the program. So coming up in this half hour, well, we've just been chatting in that very short break. I think you pronounce it Avecho. AVE is the ticker code, Appen, baby Bunting, Commonwealth Bank, so a big one for these small cap guys, and MSL Solutions. Let's get right to it. Avecho, it's for Aiden, just looking for a view. Says certainly not a buyer here, as still very green, but pending approvals and trials aside, interested to get more analysis on the business. Now, Andrew, I already know, doesn't know the business extremely well. Luke, do you know this business? Well, do you know how to pronounce it, first of all? And then tell us what you think of what it does. It's got technology, a whole portfolio. It's in cannabis, essentially, pharmaceuticals, animal health, and drug delivery, from what I can gather.
Yeah. I don't know how to pronounce it, and I wasn't too familiar with it. Sorry, Nadine. But my reading was similar to yours. It's in that sort of cannabinoid space. To me, it seems like they've got a bit of IP, and they're just trying to figure out what best to do with it. So they've got a phase 3 trial for a soft gel to try and treat insomnia, a phase 2 trial for that soft gel to treat hand osteoarthritis. And that's, this sort of thing's not uncommon for these types of biotechnology businesses where, you've maybe got a compound or something that works and you're just trying to find out, which market can it work in, can we monetize it, and can we grow? It's worth noting this is a tiny business, not just from the market cap, which is 25 mil. That's investable for me with Merewether Capital. But, last quarter, their staff costs were just $140,000. There's probably only less than 10 employees, maybe only sort of 5 or 6 in this business. So the question becomes, okay, if they have something there, what's that next step? How do you scale this up? Do they do it themselves? They're flagging using partners and trying to license. That would be more attractive because it's much more capital light, even though you do give away some upside. Look, long story short, I'm so new to it, Nadine, I couldn't say buy, hold, sell to Aiden, but it looks like he's got the right idea anyway. This is the sort of thing you chuck on your watch list, you keep watching it, these clinical trials will come through and you'll be able to make a decision later on when you get more sort of certainty about what's happening.
No need to rush into something like this. It's at such early stages, Andrew.
Yeah, I mean, it's unfair for the people in the business to use this term, but it is a lottery ticket from, I think, an investor's standpoint. even if you have an incredibly deep understanding of the technology and you work in the market, it's still extraordinarily hard to understand how quickly the approvals are going to go through, whether or not they even indeed go through, and what the commercialization pathway is going to be like. So, I love the fact that there are so many companies out there investing all this money to make our lives better and healthier and all of that kind of stuff. But it is the kind of business that they get a little bit of traction and you'll make a fortune. It's 100x kind of potential there.
Yeah, you wouldn't be
but you could
really
lose 100%
keen for them
too.
to use your money.
No. And
Yeah.
it comes back to before, it's like that. It's that risk-adjusted return. I give up some upside, but with more certainty.
Yeah, got it. Okay, we need to talk about Appen, don't we? It is on the list. This is from Cynthia. Cynthia, sympathize with you. Unfortunately, bought Appen shares at way too high a price. Everybody knows they've taken a major dive over time. Please give her a synopsis of what you think about the share. Is it just stone cold dead duck, she says, considering current situation? Should she cut her losses, move on, invest elsewhere?
Geez, I don't know. It's a tough one, right? So this again comes back to my earlier point of extrapolation, and you can wrap on top of that a really wonderful story and a really sexy story. AI, right? I'm the biggest
AI that's done by humans.
AI that needs human
human,
annotation and labeling, exactly. And so is AI going to be, well, it is a thing, right? And it's only going to get bigger. It's like no question about that. And bootstrapping these incredibly sophisticated programs requires a lot of teaching. Like anyone who has a child knows, you have to do a lot of teaching, but they kind of graduate and you get to the point where you sort of have self-learning algorithms. Now, I've already gone like miles out of my own depth here, and you can really go down the rabbit hole. But I reach a point personally as someone who's not that intelligent where I just recognize that it's just out of my circle of competence. And just to give you the old Buffett quote, the size of your circle isn't that important, but knowing where the boundaries are very important. So this one goes into the too hard basket. I love saying that hope is not an investment strategy. Someone who has a deep understanding of the field and the necessity for human annotation might be able to form an opinion. I can't, and so I'm happy to go elsewhere.
But beyond that, it has consistently been downgrading.
Yeah.
It has not had any good news flow around it. The momentum is only in one direction. I mean, isn't that enough to make you sell it?
It depends. If I knew this really well, and I actually thought the market is overreacting here, it's super cheap. There's nothing there. If you actually look at the broad brush of their trend in earnings growth, sales growth, it's actually been really impressive. It's just the market got way ahead of itself, and then they promised a little bit too much potentially. And it might be one of these transitions from human learning to self-learning that actually takes 20 years, and in the meantime, Appen just makes a bunch of bank. I don't know. That's the question.
So Cynthia right now is saying, what should I do? And this is information only, by the way, Cynthia. This is not tailored to your own financial circumstances. But
if you're an AI expert, Cynthia, and you've got an incredibly strong handle on the industry and its direction, then you don't need to ask me.
Okay.
And if you're not, then if in doubt, get out.
Okay, if in doubt, get out. Luke, what do you think about Appen? Because again, there are those that might say, well, you've written it down this far. Why get out now? Why not wait to see if management can execute its plans?
Yeah, look, I think Appen's here to make the Redbubble shareholders feel better, Nadine. It's probably the only other worst performer. Andrew's touched on it well. I think your little point was good too about, it pitched itself as an AI company, but really, providing the picks and shovels to something is very different to providing that service itself. And the market, I think, got swept up in the narrative around Appen. And the numbers too. Like, don't get me wrong, the numbers were very strong. You were riding a very strong wave. But it appears that wave has peaked. And the issue I see, a little bit like Redbubble, is rather than acknowledge that wave may be peaking and management sort of adjusting the business for that, they are ploughing more operating costs into this business to try and recapture that growth that's been lost. At first, we all thought it was COVID. Management did as well. It's now becoming clear that, 2.5 years past COVID, this business has some structural issues. little bit like Catapult before. For me, I couldn't be there until I saw management acknowledge that. And so when I read their last update, which was, it was a weak update from the numbers, but also the commentary about they plan on increasing operating costs. They didn't give an exact number, but increasing operating costs into FY23. To me, it should be going the other way. You should be winding this business back to the scale it has to be for the new paradigm that you're operating in. So, look, like Redbubble, again, forget where it's been. I know we say it all the time, but the market doesn't care about where you bought a stock. You have to look at it today. I think the market's sort of expecting at today's price, you need to have a view this business can get back to $50 million EBITDA.
Yep.
Now, they were doing 100 mil 2 years ago, so that's could be possible. But they're only going to do maybe 10, 15 mil this year. So for me, it's a sell. I think watch it if you like, but I'd have to see some things change at a management strategic level before I could really get any confidence in it.
Good, thank you. It's a sell, Cynthia. Sorry about your losses. Now, Baby Bunting, BBN, for Angus. So this is a specialty retailer. Retailer has been so hard hit. Some say unjustifiably in certain segments. Luke, you've got kids, Baby Bunting. Is it in the right space at the right time to invest in?
Well, definitely, Nadine, because it's not a discretionary retailer, as anyone with kids knows. You need the red baby pram and you need the $2,000 car seat. So, Baby Bunting's very well positioned, and you look at their results and you wouldn't know a pandemic happened. It's just been consistent. Revenue growth, profit growth alongside it. Gross margins haven't even taken a hit, which I was really impressed with. Most retailers have taken hits to their gross margins, either through being forced to discount or through higher shipping costs. Baby Bunting continues to expand. So I give them A+ on all the operating metrics. The one strike I have against this business is they're very cavalier with the reporting that they do in their presentations. They strip out some costs that I think are pretty genuine and should stay in the results. So, they report 30 mil net profit, which would put this business on about 20 times earnings. And I think that's a pretty fair multiple for Baby Bunting, considering the path they have for store growth over the next few years. But they strip out some share-based payments. They strip out what they call IT transformation costs, which is, a new ERP system. That's just cost of doing business. You have to do that every, not every few years, maybe every 7 to 10 years. Add them back, and it's about 20 mil NPAT or 30 times earnings. That's getting a bit stretched for me. So I would definitely hold it if you're there, just because they're such good operators. It comes through in the numbers. Like I said, A+ on all that. But just that valuation, I think you hold, but just watch otherwise. Yeah,
too XC to pay today's price for this business, Andrew?
Yeah, I think so. Retailers are fascinating because they really do move around, and the market is so short-term focused. You have a bad quarter, a bad half, and everyone piles out. So
City chic comes to mind.
Yeah, it happens all the time. Sometimes for good reason, maybe like with Kogan. Other times where it's just a little bit unfair. And I think there's a failure to recognise just the very inherent cyclicality in these industries. And having said all that, as Luke just pointed out, it's actually been incredibly resilient, Baby Bunting. The really nice thing about them when they're completely bombed out, actually retailers as a group, since about June or so, up about 20% or so. So some wonderful bargain opportunities to be had there. And what's interesting about it is you kind of get this phenomenon where we go through one part of the cycle where profits just naturally come down. Again, nothing structurally wrong with it, just people aren't opening their wallets and purses as much. And then you also get the multiple contraction as well. So sort of like the earnings fall and the PE falls. And so the price move is so much more exaggerated than what's normally happening with the business, what's actually happening with the business. But on the other side of that, you see that in reverse, where the earnings sort of recover as everyone gets a bit more confident and happy to spend again, and then the market multiple goes up. So I think a lot of these companies are looking interesting. I'm with Luke though. Baby Bunting's a hold for me at the moment. I'd want to get it cheaper.
Got it. Thank you, guys. The next on the list is, well, I know it's out of your most loved part of the market. However, every Australian knows the big banks and has owned the big banks or does via their super funds. So Commonwealth Bank reported last week for Max. I think to your earlier point, Andrew, it seems as if consumers and homeowners are doing quite well now. But the banks don't seem to be really benefiting from these rising interest rates in terms of net interest margins.
Yeah.
So is there anything attractive to you about the big banks, including Commonwealth Bank? This one is for Max.
Nope, I've been negative on them for years, and it's really hard. It really jars a lot of people, because particularly if you sort of look from the turn of the century for the 10 or 15 years, they just had such, even GFC notwithstanding.
Yeah.
And it was such an incredible run. There was a lot of structural factors at play: rise of the two-income household, property boom, etc., etc. So is Commonwealth Bank going to be around in 10 years? Yeah, 100% it is. Is it going to be earning more than it is today? Yeah, 100% it is. The trouble with it is, and we forget this in Australia, that banking is an incredibly cyclical industry. We just haven't had a cycle for a while. So you've got something that at the moment is really been flat for 5 years on its earnings and its dividends. I think at best you'll get low single-digit growth, and you're paying a reasonably high multiple for that. So you'll get a bit of a dividend, but if you're happy with a mid-single-digit total shareholder return over a 5-year period, be my guest. I want more than that.
Okay, got it. That's a no. Now, Luke, I'm going to be strict. It is a buy, hold, sell for Commonwealth Bank. And why wouldn't you hold it if you've got some?
Well, that's what I was going to say to Dean. I agree with everything what Andrew said. I would say sell, but no one will listen to me anyway because it's CBA, right? Look, if you're happy with the divvy at the current levels, definitely can hold it. I agree with it. It is by far the safest of the banks, and all of the risks we talked about before are not coming through in the numbers. But I can't get excited, even if I was if I pretended I was a conservative, dividend style investor. I just can't see much upside to it, to be honest. You're paying peak multiples for some very low growth earnings, really.
Okay, got it. Now, Luke, I'm going to start with you on MSL Solutions, because I do believe as well that we've spoken about this one in the past. So it's point of sale systems, but it's not a competitor to Tyro. This is sort of stadiums and really big venues that they go in and actually put in the infrastructure, correct? Would you be a buyer? Would you hold it, or would you sell?
No, I would be a buyer. I own it from Merewether Capital. I bought a little bit yesterday, Nadine, on the result they had. I thought it was really positive. So they gave an update a few weeks ago, and it was just a high level numbers, and there were probably some reasons to maybe suspect there was some underlying weakness to the business with some of the numbers they gave. Like, revenue was down half on half, but EBITDA was higher. So what's going on there? When the results came out yesterday, it was pretty clean. The answer to that question was they shifted to their higher margin products and are winding back some of their lower margin reseller revenue. The outlook for growth was pretty positive with some of their large contracts, still sitting in the backlog ready to come on. And so, at sort of 15, 16 cents yesterday post that report, I was looking at about, around 10 to 11 times EBITDA, and a clean EBITDA at that, not much investment below the line. I was happy to pick some up, just a little bit, from Merewether Capital. So, yeah, definitely a buy for me.
Buy, hold, or sell for MSL Solutions. Are you in Luke's camp? I'm
going to go with Luke here. I don't actually hold any, but we spoke to the new CEO, Pat Howard, last year with Strawman. He's really right-sized the business, really brought some discipline on there. I think they've got a very strong competitive position. I think they've got a really good product set. I think they're undervalued. The market's sort of missing the bigger picture with these ones. Very liquid, very small. Love it.
Yeah.
If you can stomach a bit of volatility, I think you look back in 5 years, you'll be pretty happy.
All right. Look, so that will be going to the investment committee. Thank you, guys. We got there in the end. Yeah. All right. Now let's circle back to the start of the show. Our stock of the day was AGL, and really pleased to welcome to the program CFO Damien Nix to discuss the details of today's result. Welcome to the program. Thank you so much for joining us, Damien, on a very busy day for you. Look, we did see a pretty soft result coming through, but it's all about the future. Damien, you knew that the market was not going to like a lack of guidance. So why have you withheld guidance this time around?
But look, I think importantly, what we wanted to talk about today was the resilience of our results, given the unprecedented market that we've been working through over the last couple of months.
Okay, so I'm sorry, we did have an audio issue there. We missed a little bit of that, but the guidance was unable to be put forward in part because there's this strategic review that's ongoing. Give us an update as to where you're at with the strategic review, because of course it was announced in very tumultuous times with the scrapping of the demerger.
Yeah, thank you. So that review is going well. There's 4 key things that the review is looking at. The first is reviewing the existing strategies where we had as part of the demerger and what those strategies are in terms of what will continue into the business going forward. The second is looking at the decarbonisation pathways of the business, clearly a big focus of the market. The third will be looking at what is the optimal mix in the energy mix of the future when you think about what that decarbonisation pathway could look like. And then finally, it is about the capital structure of the organisation going forward and how we'll fund those changes and that growth of the business. Again, that will come out at the end of September. That review is going well, and we'll provide an update to the market when we get there at the end of September.
And you will be providing guidance at that point, was my understanding. Is that correct?
That's right. Exactly right. And when we came out, we withdrew the demerger, we said at the end of September, we'll provide guidance at the same time. And I think that hangs together well because you come out with your updated review of strategy, plus at the same time, you talk about guidance for the year ahead.
But we're going through board renewal and recruitment. I mean, how did these big strategic decisions get made when the whole company is in such a period of transition?
Look, importantly, the company hasn't stopped. Company keeps operating, and that's what's really important through all this process. You saw that over the last couple of months in that unprecedented market volatility. Our company keeps delivering for our customers, for our shareholders. That is what is really important. As part of the process, we've got a board subcommittee set up to oversee this. Plus, we've got management working our way through that, and therefore that how it all feeds together as part of an overall governance structure when we think about that review. And so any new bodies and any new chairs and board coming in will have that governance that sits behind that.
Just on some of the lines in the report, now coal prices. So it's my understanding that you've hedged and have had long-term hedging in place so that you won't have any sort of impact of these rising coal prices on coal-fired electricity generation. Is that correct, Damien?
The strength of our business is we either own the coal, which is down in Loy Yang, or we have contracted long-term supply at our Bayswater power station. So that is a real strength of this business. And one of the things we've been talking about today is the resilience and the strength of that business. And the coal supply is a big part of that.
And Damien, what does that mean for customers? Because of course we are in this inflationary environment. I'm an AGL customer. My bill has gone up. And we're talking about, the broader context. We hear so much, really scary news coming from Europe, for example, when it comes to energy and electricity prices. What's happening at the coalface with your customers?
Yeah, look, customers and affordability is at the front of our thoughts. Whenever we're thinking about customer pricing, reliability of the system, that is front of our mind. Now, clearly, the way the market works, whether it rises in, whether it be input prices, whether it be rises in wholesale prices, they ultimately will feed through to customer pricing. But at the end of the day, it's about having that breadth of portfolio, that breadth of customer solutions, so we continue to work with our customers as we think about both affordability, but importantly, reliability in the system as well.
Damien, I hope you don't mind me saying that you've got a pretty tough job. I mean, if we look at some of the metrics, return on equity has been shrinking for the past 5 years. So it's dwindled from about 13.1 in FY18 to 3.7% in FY22. You're operating in a market that is so dynamic, and it is facing, these massive changes when it comes to the shift in the type of energy that we will be using into the future. So when you think about what is in your control to either simplify the business and to, bring about returns to shareholders, ultimately, that's what we're about here. What is it you're doing now? Once today's over, what's on your plate tomorrow?
So once we get through this week, it'll hopefully be a bit of a rest this evening. But once we get through that, really it's about continuing to, that stability of our business, the resilience of our business. We have 4.2 million customers, continuing to provide great services, great products to the customers, ensuring we can deliver, energy into the system at affordable prices, but also ensuring we continue to develop our portfolio. That flexible portfolio is a big part of what we're doing. Over the FY23, we have a battery coming online in Torrens Island, and that is a big part of where you'll see us continue to grow growth for our shareholders into the future. That flexibility of supply is going to be so important as we think about the energy transition ahead.
So for shareholders, and I will call them long-suffering shareholders, if you look back to sort of 2018 and beyond, I mean, you're telling shareholders to hold tight, to have patience. When will you be returning to sort of stronger electricity margins? That's still sort of a year or so out, isn't it?
look, we are absolutely leveraged to wholesale prices, and we always have been. So when wholesale prices are high, you've seen higher share prices and return to shareholders. Again, let me just say, the strength of our business, the resilience of our business positions us well as we look into the future. And I think that's the important takeaway for shareholders today.
Damien, I do appreciate your time today. I do hope you get some rest this weekend as well. I'm sure you've got many more investor and analysts call this afternoon. We'll let you go. Thank you.
Thank you. Good to talk to you.
Damien Nix there joining us from AGL. He's the CFO there. Look, I'll take the pause and take the opportunity. Andrew, I'm going to presume, your mind's not changed on AGL.
No, I mean, look, I wish them well. But it's a big challenge. And, you mentioned the term opportunity costs at the start of the program, which I think is something that investors have to always think in mind. Whenever I put my money in company A, it by definition can't be in company B. So the question isn't, is AGL investable? The question is, for someone who only needs 10 or 20 stocks to be well diversified, is this one of the top 20 opportunities in my opportunity set right now? And for me, it's no.
Well, it's too bad Mike Cannon-Brookes hasn't offered to come on the program. Trust me, I have asked. We have asked collectively many times, because I'd be interested to know what he has to say when it comes to what he's going to do as the biggest shareholder and as an agitator for shareholders. I know what his ideological goals are, but what's that going to mean for shareholders? Mike, if you're watching, open invitation. Hey, Luke, thanks for joining us from Merewether Capital up in Newcastle. We look forward to seeing you on a Friday sometime soon. We can have a drink at the last call. Andrew, I think we're going to be having a drink at the last call today.
I'm sticking around, you bet.
Yeah, all right. So if there's any companies you'd like us to cover, flick us an email, thecall@ausbiz.com.au, or you can tweet to us at ausbiztv. So you can check out that portfolio, ausbiz.co/portfolio. Don't go anywhere. I'll be speaking with the CEO of Accent Group and 4D Medical in just a moment. Lucky me.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
It's like gangs that have decided that they're going to do something mischievous.
Particularly in ransomware cases, time is often of the essence.
Join me each Friday at 2 p.m, where we'll ask the big questions to the country's top cyber